That's not an expense that actually, it's not money that actually leaves your pocket. So that expense, because it's so large, because real estate's so capital intensive and you're buying these large properties, that expense is quite high in many cases, and it's able to shelter your rental income. So to kind of give an example.
Tom, welcome to the show today.
Hey, thanks for having me on. It's an honor to be here today.
So you read this book called The Richest Man in Babylon, which I read recently. Actually, it's one of those ones you should probably read early on, which is what you did. In fact, you named your investing company Babylon Property Group, which is interesting. So it must have made an impression on you. Why?
Well, that was one of the first books I actually read as like an adult. Like, I don't have to be forced to read anymore. And, it really kind of set up the foundation of my, I guess, my personal finance journey, and how to kind of, pay yourself first and invest in things that you understand, or invest with people that you understand. So it kind of laid that foundation for me. I also grew up in a town called West Babylon on Long Island. So it kind of clicked for me. I'm like, you know what, this is going to be the name I'm going to pick, partially because of the book and partially because of the town I grew up in, and that's kind of how the name came about. But that book was monumental in my journey, and the Rich Dad Poor Dad came next, and the rest is history.
What was it about that book that it stood out for you?
The Rich Dad, excuse me, The Richest Man in
Babylon.
Babylon.
Yeah,
It
yeah.
was really just the way it was told, and just how timeless those principles were, and that's kind of overall what stood out. And the kind of the pay yourself first, make sure you keep, I think it was keep more of thy gold, if I'm not mistaken. That was a big piece, and that really helped me accumulate enough money to ultimately start investing in real estate. So I think that alone, but also one of the other pillars, or one of his other lessons that was in there was, invest with people, right? Or invest with people who know what they're doing in that specific area, right? So I wouldn't necessarily go invest in real estate with someone who's all their experiences in oil and gas per se, right? I want, going to invest with people who have experience doing real estate, if that's what I'm going to invest in. If that makes sense.
Yeah, it's a great it's a great book. Now, were you an entrepreneur from an early age, or how did that come about?
Yeah, so I've always been an entrepreneurial type. I've been telling my parents since I was 5 years old that I was going to be in business, and kind of growing up throughout the years, I would always work to find ways to make money. Right, I would go door to door doing car washes, mowing lawns. I did garage sales. I used to make CDs and stuff for people back in the day, when that was a thing. So I used to do pretty much whatever I could to make money. And then kind of as I got into my teens, I really wanted to be a full-time entrepreneur, but I got stuck in that cycle of, I'll go to college and get a degree and get that 9 to 5. And like kind of everybody around me was telling me to do that. So that's ultimately what I did. But then when I was in college, I kind of realized, okay, this is not going to get me to where I want to go. Like I always had this fundamental understanding of, like, how is studying this book here going to make me money? Like I knew that studying this book was not going to make me money. What was going to make me money is actually going out and doing things. And that's how I kind of got started in real estate. I went to a 3-day weekend that was focused all on real estate syndication, fell in love with that strategy, started investing as a limited partner, and ultimately was able to get in an 82 apartment complex as a general partner in a deal back in 2017, which has since came full cycle. But that was exciting.
That's pretty awesome. Now, but you finished your college training because you actually became a CPA and you went out and started practicing. And how did that come about? And what was the conflict between that, which is a schooling career, and this entrepreneur? Like, what was the conflict between the two, and how did you resolve that?
Yeah, so the conflict was about lifestyle, right? Partially about lifestyle, partially about money. So lifestyle wise, if you go to a school for accounting, like when I came out of school for accounting, I got a job at a national accounting firm. I was in their general assurance department, so I was doing audits effectively. And I looked across the table at the people who were 10 years ahead of me, and I was like, this is just not where I want to be. People would stay in the audit room until 1 o'clock in the morning because they didn't want to go home to their spouse. And, they were just, it was a constant like 80, 90 hours a week. And it wasn't even like it was getting you to where you wanted to go. So I was like, there's just a fundamental mismatch there in the lifestyle of it. And also from an earning standpoint, at the end of the day, you're trading your time for dollars there. And in fact, it's even worse than trading your time for dollars because you're salaried in. Like, so no matter how much time you work, you're still getting paid the same amount effectively. So all that just didn't really make sense to me. And I saw that, being an entrepreneur, getting into business, you have a lot more opportunity to grow your income, as well as have the freedom that you want, the autonomy that you want. And that's kind of where that divide was. So after I did my first year at that accounting firm, I was like, okay, this is not for me. And I immediately started looking for ways that I can get involved in real estate and find more entrepreneurial things to do. Which, kind of long story short, I found this firm that I work at now, Hall CPA, also known as the real estate CPA, and it's really an entrepreneurial type of firm. So I was able to really express that entrepreneurial side of me, help build a lot of things out, lay the foundation, get involved in things like sales and marketing, and really have that autonomy that I was looking for. That's kind of where I kind of found that fit, was because of the entrepreneurialness of the firm. If it was just a normal accounting firm, I don't think I would have been able to deal with it for too long.
So this is a really good point. To everybody listening, I mean, this is a similar process that I went through as well in the industry that I was in out of college, which was actually much different. It was nightlife, but I looked at, hey, what is like the pinnacle of this industry? Okay, the pinnacle of the nightlife industry is I own a club. What does my life look like if I own a nightclub? Well, I'm probably not married. I'm probably chasing around younger women, and I'm probably miserable. And I'm probably drinking too much. And so, now there's always caveats to that, but if you look at kind of like how many people, like just any firm that you're in currently working for, what's the top of that look like? How long is it going to take you to get to that if you really want to, or even if you make lateral moves? Is that the life you want to live? And once, like, I realized that same thing as I was in that industry, and I'm like, this is just not going to work out well. And so I think if anyone that's listening, if you're working a 9 to 5 and you kind of look at that, that's really motivational to think about. You're like, hey, if I'm on this path and I stay here, where am I going to end up? I was able to make the pivot early on after kind of that ended up being like this big driver for me. And then it's just about gathering the resources to be able to go and move into what makes more sense for your life. There's risks when it comes to entrepreneurship, big risks. And some people can't overcome that, but if you don't do that, you could end up like the other guy. Right. So I'm curious, Tom, when you're getting into this, sounds like you made, a next move into like a more of an entrepreneurial CPA firm. How did that set you up for the next, phase of your life, or the next chapter of your life in entrepreneurship?
Yeah, absolutely. It's a great question. So when I got to this firm, where I think around $200,000 in revenue, so there wasn't really much built out. We're flying by the seat of our pants in the beginning, right? There wasn't much of a foundation. So really, what that allowed me to do was get into a role where I had to build, right? I had to build. I had to go and hustle. I had to go and get contacts, meet people, do sales, do marketing. It was very much like building your own business in a sense. And at the time I came in, I think, as an associate, and I worked my way up to partner. So that really gives, at the partner level, it really gives you the autonomy to do a lot more things. Like now we're looking at business acquisitions and building teams, and what's the next thing? What marketing channels can we add to the firm to attract more clients? How can we retain more clients? It's very much more high level, rather than me sitting at a desk saying, what, I'm going to be filing these tax returns all day, every day, or I'm going to be, sitting at the audit table doing audits all day, every day. And that's very restrictive. But on being able to build and make things happen, I guess that's the word, being able to influence and have over the decision-making and the direction of the firm is really empowering, versus just, kind of being a cog in an existing wheel. And that's what a lot of, older firms are.
Now, I mean, so you're a bit of a hybrid. You're the entrepreneur, startup guy, but yet you're in a field where you have the potential to be a high income earner as well, and therefore you've made some investments. And other people that are listening and watching this may have some investments in the stock market and mutual funds and things of that nature. You have decided to invest in real estate. talk about why you chose that, because there are other options out there, and yeah, and you must have looked at those options and said, no, I'm not going to do that. I'm going to do this. Why? What options did you choose to invest in, and why did you pick those?
Right. So I started investing in multifamily, and that's really because it really just made sense to me on so many levels, from a philosophical level, if you will. Like real estate, there's a lot of technology disrupting the entire world right now. Things are coming and going. They're going to be here today and gone tomorrow. The reality of the situation is people always need space to live, space to work, whether that's at home or somewhere else. They need space. And until, we have Honey, I Shrunk the Kids technology, real estate, in my opinion, is not going anywhere. So it's going to be here today. It's going to be here, way after I'm gone. So I like the longevity aspect of it. I also liked the multiple profit centers, right? So you have appreciation. It generally appreciates over time. You can also in multifamily force appreciation through value add and increasing the NOI. So that was always very attractive. Then you have the tax benefits of it. So one of the best parts about real estate is you can effectively get your rental income tax free because of the expense called depreciation. So you could, in other words, you can have a tax loss for tax on paper for tax purposes, but despite the fact that you're actually generating positive cash flow. So that was always attractive. And there's principal pay down. Then in multifamily specifically, of economies of scale, instead of having to go buy 10 single family houses, you can just buy one apartment complex in one transaction. It's a little bit more complicated than buying a single family house, for sure. But all that stuff, that's what attracted me to real estate, and also the stability of it for the most part. The stock market, it's very easy, to put your money in the stock market and it goes down, and you could watch that every day, and it can give you like, a lot of anxiety. So, basically after 2008, I graduated high school. I'm going to date myself a little bit here, I guess, but I graduated high school in 2009. So I'm not that old, but the point is, like, I kind of came out of high school during that economic downturn, and everybody's so fearful of the stock market that kind of got into me too. So I was like, you know what? Real estate's on the up and up right now. It's on the upward trend. All the profit centers I just mentioned, that's kind of why I got into it.
Let's talk about taxes, since you know a little bit about the subject. How is it possible that you can make an investment? Let's say you invest $100,000 and you get cash flow distributions, you get $6,000-7,000 in a year, and you're showing a taxable loss, right? And the poor investor takes the K1 to his CPA, and the CPA goes, "Oh, so sorry, Tommy, that you're such a bad investor." And you're like, "No, let me explain to you." And it's something that's so unusual. Explain to me at a real high level how taxation of real estate works.
Yeah, absolutely. So the first thing to understand, I guess the first thing to understand is when you buy a property, you don't get to expense it the first year, right? So every single year, a portion of the property's building value. So land is never depreciated. I'm going to get into depreciation in a second, but land is not depreciated. But your building's value will be depreciated. Basically, you're gonna have a depreciation expense each year, a little bit each year, and there's ways to accelerate that and increase that. But that expense is only on paper. That's not an expense that actually, it's not money that actually leaves your pocket. So that expense, because it's so large, because real estate's so capital intensive and you're buying these large properties, that expense is quite high in many cases, and it's able to shelter your rental income. So to kind of give an example, let's just say you had $100,000 in rental income, right? And then you have $60,000 of hard expenses. And what I mean by hard expenses, I'm talking about utilities, repairs and maintenance, legal fees. Maybe you're paying a leasing agent to rent it out, property management fees. All of these fees, this is money that actually leaves your pocket at the end of the day. It goes to somebody else. So if you took this example, $100,000 in revenue, $60,000 in hard expenses, you'd be left with about $40,000 left of income, right? Or cash flow. Now, in many other businesses, that's it. You just pay tax on that $40,000 and, you call it a day. But because the depreciation expense in real estate is so high, let's just say that you had $50,000 of depreciation. And the reality is it could be much, much higher than that. But let's say you had $50,000 for the sake of this example. Well, now on paper, you have your revenue of 100,000, you have your expenses of 60,000, then you have this depreciation expense of 50,000. Now you're at a loss of $10,000. And this loss is only on paper, because remember, this depreciation expense doesn't really exist. It's called a non-cash expense or a phantom expense, because now when you go report your tax returns, you're reporting this loss on your tax returns, but yet you just pocketed $40,000 in this example of cash flow. So you didn't have to pay tax on your cash flow. And that's just scraping the iceberg, or the tip of the iceberg in terms of tax strategies, is your ability to not have to pay tax on the cash flow.
Tom, so question, let's talk about what happens when so one of the big things that happens, you get into this, you get this bonus depreciation, and obviously, everyone can use it, but it doesn't work. You can't take, not everyone can take the full benefit of it. Maybe explain a little bit about who can take the full benefit of it, and how it works with the different levels of people. And then also what happens on when it comes to recapture, when we do sell a property.
All right, absolutely. So I'll break it down first for the people who can use it, right? So if you, first thing to understand here, just to lay the foundation of this, that Section 469 of the tax code, which was put into place in the Tax Reform Act of 1986, made all rental activities passive by default. And what that meant is that, and there's two buckets of income, basically. There's passive income and non-passive income. If you have a job or you have an active business you're involved in, your income is generally going to be in the non-passive bucket. Then if you have a business that you're not active in, or you have real estate, it's going to be in the passive bucket. So these rules state that passive losses can only offset passive income. So in other words, the passive losses from real estate can generally not offset your active income or your non-passive income. And that's where most people fall into the bucket. Now there's something called the real estate professional status. And the real estate professional status was put into place in like 1994, after pretty much over that 8-year period. There's a lot of lobbying by the real estate industry to get this put in place. And what it does is, if you work more than 750 hours and more than half your total working time, and that's the key, more than half your total working time, that's what trips a lot of people up, in a real property trade or business, then you can effectively take the losses from your rental properties against your active or your non-passive income and use it to offset and basically help reduce your taxes. So let's say, for example, let's just say you made $100,000 of income that was non-passive, right? And you're able to qualify as a real estate professional, or your spouse was able to qualify as a real estate professional, and you had this $10,000 of losses that I was talking about before from this rental property. Well, now this $10,000 of losses are going to be able to offset that $100,000 of income you have, and you're only going to pay tax on $90,000 of that. So if you were just, I'm pulling a number out of a hat here. If you're in the 22% tax bracket, and we could always add zeros to this and increase this, but just for example, if you're in the 22% tax bracket, this $20,000, this $10,000 loss is going to be worth $2,200 for you. Now, in many cases, these numbers are amplified. I'm just giving an example. I see, for example, many of real estate investors are often saving $10,000, $20,000, $30,000 using this strategy, but that's just an example of how it works there. Now, if you're not a real estate professional, which is the majority of investors in my experience, then what happens is these losses cannot offset your active income, and instead they will only offset your other passive income. So maybe you own other properties that have passive income. They can offset the income from those properties, or the gain on sale of a passive activity. So when you sell a property, or if you're invested in like a syndicate and that property is sold, you can use these passive losses to offset the gain on sale. And that in and of itself is a big perk in real estate. So in my experience, a lot of investors really get, bummed out when they get to hear that, oh, I can't take this against my non-passive income. But then they start to realize over time, oh, look, you can offset your cash flow from it again, your rental income, and then also the gain on sale when you ultimately sell a property can help shelter it. And that's really the benefit for those folks.
So Tom, I got one thing on this that I think sometimes there's this like gray area, or people are in these industries and they're not sure, hey, would I qualify for real estate professional status? So I'm going to call out a few of these, and I want you to tell me if they technically would qualify, or if there's a version that could qualify or not, because I think there's, and maybe I don't even know the answer to some of these. I'm not in these industries, but like, say for example, a mortgage broker. Would that person qualify for real estate professional status?
No, that person would not qualify because they're believed to be in the financing business, and there's a few tax court cases on that around that confirm that. So I'm 100% confident that a mortgage broker as unfair as it may seem, does not qualify as a real estate professional.
What about a real estate tax advisor?
Unfortunately not. So we would be considered to be in the accounting industry.
But commercial real estate broker or residential broker.
Yes. And because there's 11 real property trades or businesses, and one of them is brokerage. And if you're an agent or you're a broker, then that would be considered a real property trade business for these purposes.
Oh, that's really good to know. Michael, go ahead.
Yeah, so you have these taxable losses while you're holding a piece of real estate, and then typically they will carry forward until such time where you actually sell something. Now, typically when you sell, you have this giant capital gain, right? And at one point you got to pay the piper, right? Or maybe
right.
Or maybe you don't. What are some tax and what you said is that these carry forward losses can be applied towards passive gains, such as when you sell them. And so you're able to consume those. But what are some other tax strategies that you see where if you do make an investment in a multifamily or commercial real estate and 4 years later it sells for a massive, capital gain, what are some options that investors can consider to possibly not pay taxes or defer taxes?
Right. So to defer taxes, so the first thing is it depends on your level of control over the deal. If you have control over the deal or you're on the management team and you want to go ahead and do a 1031 exchange, you can go ahead and do a 1031 exchange and basically take the sales proceeds and buy another property, usually a larger property or multiple properties, and you're able to defer the tax, continue to keep, accumulating more real estate and continue building your wealth. So the 1031 exchange, very classic. That's the first, that's one of the main options people consider. Now, the second option, this has been really popular over the last few years, thanks to bonus depreciation. And that is, say you sell that property is going to be sold, 3 years is going to be sold. Well, you can look at this form on your tax return. It's called Form 8582. And that's where your passive activity losses or your suspended losses that have accumulated are stored or just reported right every year. And if you look at that and you say, okay, well, I'm estimating this gain to be, $100,000, and I have $120,000 worth of losses on my Form 8582. Well, you don't need to do anything in that case. You just let it offset and you're good to go. It'll just automatically offset it. Now, if you don't have enough passive losses, you have a few options. You can go and invest in a property directly. So maybe you go out and buy your own property, have a cost segregation study run on it, and then you can use bonus depreciation or just depreciation in general to offset it. And I'll get into a little bit more about the bonus depreciation in just 1 second, because there's something that people need to be aware of around that. But that's one way to do it. Or you can go and invest in a syndicate. So you can go and invest in a syndicate. If assuming they're going to do the sponsor's going to do a cost segregation study on it, you can use the losses from the syndicate to offset the gain on the sale. Now, that the key to this strategy is that the property the new property has to be bought in the same calendar year, same tax year, which is the calendar year for most taxpayers, as the property is being sold. So that's why syndicates are so popular for this. I've actually did this last year. I was invested in a syndicate. It sold, and then I invested in another syndicate before the year end. I got the passive loss passed through, and now I'm not going to pay tax at the federal level, which is very nice. So that's one way to go about it. Now, something to note about bonus depreciation, it is starting to phase out. So 2022 will be the last year you're going to be eligible for 100% bonus depreciation. And in 2023, it goes down to 80%, which is still going to be quite powerful. We've run the numbers on it, still packs a very powerful punch. And 2024 goes down to 60, still pretty good. And then 2025 goes down to 40%, and 2026 goes down to 20%. And 2027 under current law, it's gone. So something that a lot of people have been doing right now this year, and I'm sure they're going to continue doing it next year, is making their investments now. And the reason why they're doing it now, we're going to be planning to do it next year, is so they can lock in that bonus depreciation at those high rates, so that when their syndicates or when they sell properties 2, 3, 4 years from now, they're going to have all these suspended passive losses.
Which leads me to the idea of tax planning. And I underappreciated this for years, right? Because my MO has been, well, you take all your stuff and you give them to the CPA, and the CPA files the taxes. Now, I've since learned that you actually need some tax strategy, some tax planning. And you just mentioned some of those things. But why is it important for a real estate investor to actually start thinking about tax planning and maybe actually work with a tax strategy person and possibly in addition to their CPA?
Yeah, Absolutely. And that's because when you're doing your tax returns, when you're going to your CPA and you're handing them all that information, they're just reporting it. They're just reporting the activities that happened last year. It's basically a report card, right? They just report it. Whatever happened last year gets reported to IRS, and you file your taxes. And the chips have already fallen, if you will. Whatever happened last year happened. So really, the importance of tax strategy is having a plan of things and actions and strategies that you're going to implement throughout the year or throughout the years. Sometimes you have to do this stuff years in advance. And so that when your tax return finally gets filed, you're getting better results, right? Because it's really like I kind of just said a little bit. It's the actions you take, the strategy you implement throughout the year that are actually going to implement that it's going to actually going to influence your tax return. And usually once the year ends, once 12/31 comes around, there's things you can't, there's a lot of things that you're not going to be able to do anymore. So it's important that you be proactive, especially with real estate, where there are potentials that you're going to potential that you're going to have to pay massive capital gains tax. But there's also potential for a lot of tax savings and a lot of strategies you can implement. So you want to meet with a CPA or a tax advisor to go through that on the onset, whenever you're buying a property or whenever you're making a fundamental shift in your investment strategy, really just to make sure that you're taking advantage of everything that's available to you, and you're taking the right actions throughout the year or throughout the years. So then again, once that tax return gets filed, you're taking the best advantage to it, because again, it's just a report card, and you have to take those actions beforehand to influence it.
And guys, all CPAs are not the same. I had a CPA prior to, so I had this phase where I was doing much more crypto and stock investing than real estate, and I had a CPA that was specialized in that. I didn't change CPAs fast enough when I got back into the industry, and it came back to bite me because they didn't have the right setup. Like, I should have been running things through an S corp. I wasn't, so I ended up paying extra self-employment tax. There were just things that they didn't quite understand about the real estate professional status. So a lot of you sitting at home should run an audit. If you are thinking about getting into real estate or you're already in it, you got to have someone that's versed in that version of the tax code and understands how it all flows together and how it all works, or else you're really at a disadvantage and you might not be maximizing your full potential with real estate. And I think a lot of people, like investors, LPs especially, they'll come to us and be like, "Oh, hey, do you have any recommendations? Because I don't think my CPA is handling this correctly." And you'll be surprised. It could be night and day different between what they're telling you and what somebody that's actually up to speed on how multifamily works will tell you.
Yeah. Give Tom a call. Tom, how can people get in touch with you?
Yeah, absolutely. So if you want to get in touch with me, the best way to do that would be by heading over to our website, therealestatecpa.com. If you go to therealestatecpa.com/multifamily or /multifamily, I guess people would say, we have a guide for tax strategies that your CPA is not telling you about. So you could check that out and learn a little bit more. We always work with clients on tax planning as well as tax preparation. So we kind of do everything, which is great. But yeah, that's the best way to do it. We also have a Facebook group, Tax Smart Investors. You just find us on Facebook, but those are the best ways to get in contact with me.
Hey, it's been great hanging out with you, Tom. Thanks for bringing us up to speed on tax code.
Yeah, absolutely. Thanks for having me on. It's been fun.